Welcome to course number 8, Student Loans and Education Financing. In this lecture, we'll explore the differences between federal and private student loans. Understanding these two main types of loans will help you make better decisions about borrowing for college and managing repayment after graduation. Student loans are money borrowed to help pay for college costs like tuition, books, and living expenses. Unlike grants or scholarships, loans must be repaid, usually with interest. There are two main categories of student loans: federal loans provided by the government and private loans offered by banks or other lenders. Federal student loans are funded by the U.S. Department of Education. They are the most common type of student loan and are usually the best first option because they offer lower interest rates, flexible repayment plans, and borrower protections that private loans don't always provide. There are several types of federal student loans. Direct subsidized loans are based on financial need, and the government pays the interest while you're in school. Direct unsubsidized loans are not based on need, and you're responsible for the interest from the start. PLUS loans are for graduate students or parents helping their children, and they have higher interest rates. Federal loans come with significant benefits, such as fixed interest rates, income-driven repayment options, deferment, forbearance, and even loan forgiveness programs for certain careers like teaching or public service. These protections make federal loans more manageable over time. Private student loans are offered by banks, credit unions, or online lenders. They can help cover costs not fully met by federal loans, but they usually have higher interest rates, credit requirements, and fewer repayment options. Unlike federal loans, interest rates may be variable, meaning they can change over time. Private loans may be useful if you've already maxed out your federal loan eligibility and still need additional funds to cover expenses. However, they should be considered carefully as they lack many of the borrower protections and benefits that federal loans provide. To compare, federal loans are generally safer, more affordable, and flexible, while private loans can be more expensive and risky but might fill funding gaps. Federal loans don't require a credit check for undergraduates, while private loans often do. Federal loans offer repayment support, private loans usually don't. Let's consider a student named Taylor. Taylor receives federal subsidized and unsubsidized loans to cover most tuition, but still needs extra money for housing. After comparing options, Taylor takes out a small private loan from a credit union. Taylor now understands the differences and knows to prioritize federal loans first. When borrowing, always start with federal loans before turning to private options. Borrow only what you truly need, compare lenders, and pay attention to interest rates and repayment terms. Planning ahead can save you thousands of dollars over time. To summarize, federal and private student loans both help pay for education, but they differ in cost, repayment flexibility, and borrower protections. Federal loans should be your first choice, with private loans as a last resort. Understanding these differences helps you borrow smarter and manage debt responsibly. This concludes our discussion about the federal and private student loans. In the next lesson, we will learn about the repayment terms and interest accrual. See you then.